Now, it's my pleasure to introduce our presenter today, Karen Lascelles, and I swapped out my stuff, so hopefully that introduction right there is going to be good enough. I can say one thing about Karen. She is an awesome presenter, and I absolutely love to be on everything she does, so we'll turn the time over to her.
Thank you, Colin. And you all had me 2 days ago, so at least you know who I am. So welcome back again today. We are going to be looking, if I back it up a little, we're going to be looking at part 4 of this series, Valuation Approaches, and we're looking at the completed transaction in Guideline public comparables method. And basically what that is saying is we're looking at our market method now. We looked at, the income approach, you looked at the asset approach, and now we're looking at part of the asset and part of the market approach today. So we will look at asset approach, adjusted net assets. We'll look at excess earnings. And then in the market approach, we're going to look at completed transaction method, or CTM, in the Guideline public comparables method, GPCM. So we'll also talk about, after we've done all these calculations and we've looked at these methods, how do we select an appropriate method? How do we know what fits for our company and for our study that we're doing? So let's look at the asset approach. So what are some of our underlying assumptions if we're going to use an asset approach? First off, we have to have the ability to unbundle. So what does that mean? That means we're not taking all the assets together as a whole. We can unbundle these assets. We can separate out each of these assets. So as it says here, the assets are capable of being liquidated on a piecemeal basis. So you could sell the building separate than the equipment, separate than any vehicles, things like that. So we can unbundle all these assets and sell them piecemeal. And then we have to have the ability to liquidate. So we have to be able to sell these assets. The interest being valued has the authority to direct the divestiture of the underlying assets. So what is that saying? That's saying the interest of the company that's being valued has the authority to say, yes, we can sell these assets. And why is that important? If you think back to what we talked about a few days ago, that whether we have a controlling interest in the company or a non-controlling interest in the company, if we have a non-controlling interest in the company, we don't have the ability to say, let's divest ourselves of these assets, let's liquidate these assets. So an asset approach is not likely going to be pertinent in that case. There isn't that ability there. So we have to make sure that we're understanding way back to day one, what's the purpose of our valuation? What portion of the company are we valuing? We need to know all of these details in order to determine what methods make the most sense. We talked about this as well, that an asset approach typically works well asset-intensive companies, especially like real estate holding companies, also companies that have poor or negative cash flows. Those companies, we tend to work well with an asset approach. Other companies where there's a significant amount of operations and good cash flows, typically the assets are there backing up those cash flows. The assets are being used to generate that income and generate those cash flows. So the asset approach is not as important. The value of the assets lies in their ability to generate those earnings. So relevant businesses, asset-intensive, non-operating businesses, real estate investment companies fit well into this, holding companies, whether they're for real estate or for other investments, they fit well typically with an asset approach. Businesses experiencing operating losses. Again, because even if the company is experiencing losses, it doesn't mean that they don't have any value at all. But it might come down to the value being the value of the assets themselves. And I've certainly had that happen in the past where even it's an operating company, but not a significant amount of cash flows, that at the end of the day, the assets were worth more than the operations themselves. So you can't just take it on face value and say it's an operating company. The asset approach doesn't matter, because that might not be the case. And then startup companies. Also, as we talked about startup companies being in the infancy stages and really being at a growth stage. And if you remember the chart that we had with the cash, where are they getting their cash from? You know, they're starting out by debt and equity financing, and then they're building up their own cash. So startup companies often would work well with an asset approach. So what are our two main methods of utilizing the asset approach? We have an adjusted net asset method and an excess earnings method, which is a hybrid method. And the reason it's called a hybrid method is that it utilizes a portion of the asset approach and a portion of an income approach, the earnings method. So we're going to talk in detail about both of these and kind of go through how they're calculated. I would say we talked a little already about adjusted net assets, and that's a very common one when you're using an asset approach. So what are adjusted net assets? Our first bullet here, you can see, right? Equity equals assets minus liabilities. So what is that? That's our accounting equation, right? Our basic accounting equation, assets equal liabilities plus equity. It's just formulated a little different here. And what does that give us? That gives us the equity in the company. So if we take all the assets in the company minus all the liabilities, that's the equity. Now, we talked quite a bit a couple days ago about generally accepted accounting principles, GAAP, and how companies keep their books. So reminder that when we're looking at equity on the financial statements, that has pretty much nothing to do with the fair market value of a company and the fair market value of the equity. And I say that with a grain of salt. It might equate to the fair market value, but in most circumstances, I would say it does not. You know, it very rarely even comes close for most companies. So, and part of that is, if you go back and remember that generally accepted accounting principles, where you have our assets on the books at cost, what we bought them for, less our depreciation, less the depreciated value. So we're not accounting for those assets at whatever they're actually worth, fair market value today. What can we get from in the market? That's not on a company's financials if they are utilizing generally accepted accounting principles. And then adjusted net assets. So what is this? How do we get to adjusted net assets? We restate our assets and our liabilities from the historical book values to our current market values. And we'll talk more about this, but it reflects a more realistic economic picture. And I gave you the example a couple of days ago of the building bought 40 years ago for $50,000. That's now worth, I think I said 1.5 million. Well, it was depreciated over a useful life of 39 years. That would be the life that's used. So it's now on the books at 0 as a net value, but it's worth 1.5. So we need to adjust the balance sheet to that 1.5 million. And where do we get that number? We get it from a commercial real estate appraiser. We hire an expert, or the client hires an expert that can give us that number. And what we'll do is include their report in with our report and highlight that we have an expert that gave us those numbers. In more rare cases, if the assets are not worth as much, I would use a management estimate or say a real estate assessment value, but one, it's going to depend on how important or material it is to the company itself and to the valuation. So if I know I'm going to be relying on an asset approach, I'm not going to do that. And also, if I'm doing that, I'm going to have to put a limitation in there and state that had this been done, the value could have been different. So to be cautious with that, and just really, you know, if you're doing a full valuation, for whatever purpose it is, but especially if you're doing it for litigation purposes, estate and gift tax purposes, you can't cut corners, you know, and clients will want you to cut corners in some, you know, do we have to pay the extra $2,000 for the commercial real estate appraisal? Do we have to pay the extra X amount for an equipment appraisal? Yes, you do. You know, as much as you'd like to be able to say no to make sure you get the job or whatever, you have to make sure that we're following our standards and that you're doing it correctly. So what are some typical adjustments when we're looking at adjusting the net asset value and adjusting the books to be fair market value. So we have accounts receivable. In accounts receivable, we're going to want to look at, is there anything out there that is uncollectible? You know, does the client have a reserve for bad debts? And if they do, is that allowance reasonable? So part of that can be looking at the accounts receivable. How old is it? Talking to management about their collections. When we did our ratios, we can be looking at the ratios and seeing, you know, what's their days in AR. Does that make sense? Is it in line with the industry? Those sort of questions and analyses will help us understand if there needs to be an adjustment there. Inventories, accounting methods, we talked about that a couple days ago, adjusting for last in, first out, average cost, adjusting for inventory methods. But another adjustment, and one of the bigger adjustments might be, is there obsolete or excess inventory? So oftentimes clients might not make an adjustment for this, perhaps for financial statement or tax purposes, they want to keep it on, but we need to really understand, is the inventory that the client has good inventory? Some of that we can assess when we're doing our site visit. So it's one of the benefits of getting out there, visiting with the client and seeing what they have. On the flip side to that, you know, in a couple hour to a day tour of their facility, whatever that is, you're not going to really get an incredible sense for obsolete or excess inventory. So it's really going to depend on the client. It's going to depend what more happens. What I've seen happen is, you know, you go on a site visit, the client says they don't have excess inventory or all their inventory is accounted for, and you go into the warehouse and you see this, you know, dungeon in the back with a ton of stuff with a ton of dirt on it. And that's when you ask the question. So it's not like we're going in and observing inventory counts, but the site visit can still give us some information on that. Fixed assets. So we've talked in length at this. What are we adjusting our fixed assets for? We want to make sure that they're at our fair market values as opposed to our depreciated values. We're also going to want to look at depreciation methods because we want to make sure that our cash flows are accurate. I mean, we're adding it back there, but is our net income accurate? And if we're accelerating depreciation, if we're manipulating numbers, you know, management has some say in how they're depreciating things. Is it being done properly? Does it make sense? We're going to want to look at those. But especially with the asset approach, we want to look at our fixed assets and make sure they're at a fair market value. And again, appraisals may be necessary, equipment appraisals, real estate appraisals, whatever that may be. What we tend to do when I'm doing a valuation is we have appraisers that we commonly use, and we will often hire and retain the appraiser, and then the client will pay us. But it can be done in any number of ways. You can give the client some contacts so they can get their own appraisals. They might know somebody already, however that will work. If you're looking at bank financing, the bank will have their own appraisers typically, and that part will be done separately. And we talked about this, I think, but another thing to think about is even if there's not real estate or significant fixed assets on the books, we need to understand if they have a rent expense on the books and no significant fixed assets, who are they renting from? So are they renting from an independent third party, which typically will be at fair market value, or are they renting from themselves, which will typically need an adjustment? Because if you're renting it to yourself, you're either going to pay excess rents because you want more favorable tax situation, or you're going to pay less than fair market value rents because that's all the cash flow that you can afford. So either way, they're often not at fair market values. And one way to get that, you can do research around it, which is often what we'll do. But if there needs to be a building appraisal in addition, for instance, an estate tax return in the person that's deceased owned part of the building operations as well, then that's already coming to you. And in that data, the real estate appraiser will give you information on fair market values of rents. So that can be another source of getting that information. Intangibles are another typical adjustment. And one thing we want to look at there is, are the items on the books truly worth anything? You know, if we're doing financial statement reporting and looking at goodwill, let's say, that's going to be adjusted for GAAP purposes, but maybe these clients aren't doing formal financial statements. Maybe they're not publishing financial statements. Maybe they're not audited. So are there items on the books that are not actually, do not actually have value? We need to look at that. Non-operating assets, things like excess cash, certain investments. How do we determine that, right? So how do you determine if a company has excess cash? I think there's a few ways that you can do this. One of them is taking the balances. We did a comparative analysis back a couple of days ago. We were comparing our industry to, say, Risk Management Association's data that was published, or to Guideline, public companies that are out there with data that's published. We can look and see if the cash is typically 10% of total assets, then why is our company's 30%? You know, maybe we need to adjust it down to the 10%, bearing in mind that maybe the number is skewed because we have significantly less fixed assets than others in the industry, or ours are depreciated further. So you can't just compare and make a quick adjustment. You have to actually analyze the financials and understand what's in them. But that can be one method of doing it. You can also look at just the general cash flow and the working capital requirements. So analyzing the client's numbers and understanding, hey, is there excess cash being held here? And talking to management. They might have excess cash because they're planning for an expansion, or there's some reason that they're holding that cash into the company and not bringing it back out to themselves. Certain investments could be non-operating assets. An example of that would be, you know, you have a manufacturing warehouse and they have a large operation, a large warehouse on X amount of land, and then they also have a parcel of land next to it in case someday they wanted to expand, but they're not using that parcel of land. That would be an investment that's not contributing to current operations. That's a non-operating asset. The same with some investments. They might have put money into, say, some sort of an investment that's non-operating. It's just sitting there holding money, reinvested into the company for the future, but not directly affecting or creating anything for actual operations. Then we go on looking at the liabilities. So do we have any below market debt? Do we have any shareholder loans? And also looking at, are these items going to be paid back? And the same with, on the shareholder loan end, there might be assets on the books, shareholder loans given to shareholders, loans given to shareholders. Are those loans going to be paid back? And what's the purpose of our valuation again? You know, what does it look like for the specific valuation that we're doing, and analyzing all of those numbers? Again, it's looking at the financials, but it's also talking with management and understanding what's in the financials and why. And there is a poll question, if everyone could please respond. All right. So now looking at the asset approach, adjusted net asset method. This is, whoops, I just moved the slide. Sorry about that. So here's a good example of, you know, what is this going to look like in our report? So we are starting with our actual balances. So this is the client balances. So you typically see, you know, year ended 12/31/19 or whatever it is. And here's our client balances, unadjusted. And then here are our adjustments coming in here. So we have inventory being adjusted. So maybe we had some obsolete inventory. So instead of inventory being $750 on the books, the inventory should really be $700,000. And then the next one are fixed assets. We are increasing it by $500,000. And that sounds like a big adjustment, right? It's really not. That's pretty common when we're looking at an asset approach, especially if it's intensive equipment in a company or intensive land, real estate. So those two numbers are increasing our total assets, increasing and decreasing. The net is an increase. And then we're taking the shareholder loan off of the books. So there's that 50,000 that comes off. So we have a net assets beginning of 685,000. The actual fair market value of those net assets is up 1,185,000. And why is it net? Because it's net of the liabilities, right? So, and this question was brought up a couple days ago, but in case anyone doesn't remember, excuse me, in case someone doesn't remember, the balancing to this account, where does this go, right? Where's our net? That's to equity. So what we're saying here is we have more equity in the company. The company's worth more in the equity than what is showing on the client books. So just to make sure that you're seeing where that's going. So capitalization of excess earnings. So that was an asset approach. So here we took our assets and we're saying, here's the value, right? It's much more simple really than an income approach or a market approach, honestly, because it is what it is. It's the value of the assets on the books less the debt. So there's our value. That's the value of the company on this method. So let's move to a capitalization of excess earnings, and there's more to it. There's more to the income approach. You already talked about that, I believe yesterday. So let's see that, how does this work? Capitalization of excess earnings is using a portion of the asset approach and a portion of the income approach. So again, hybrid valuation method combines the asset and income-based approach. And what is our theoretical premise? Why are we doing this? And why we're doing this is we're saying the value of a business is equal to the sum of the fair market value of the net tangible assets and the value of the intangible assets. And unfortunately, what I've seen some people do in valuation, and typically not true valuation professionals, I will tend to see this more from a CPA trying to calculate value, is that they will do an income approach, let's say a capitalization of earnings, and then they'll add the value of the assets on top of it. So it's like they're almost trying to do this, a capitalization of excess earnings, but instead of using excess earnings, they're using all of the earnings. So just to be careful of that, that's not how we're doing this. We're not doing an income approach and then just adding all the assets back on top of that. So our theory, again, tangible assets plus the intangible assets. So this method is saying, okay, we got our tangible assets right back here in our adjusted net asset method. Now what's the value of our intangible assets? That's looking at excess earnings. So capitalization of excess earnings, our formula, business value is market value of the net tangible assets plus the value of the intangibles. And here we have to determine, how are we determining the intangibles? Market value of net tangible assets, we just did that. That's the adjusted net asset method. But then the value of the intangibles, capitalization of excess earnings. So valuing intangible assets. How do we value our intangible assets? The value of intangibles is reflected in the level of earnings that exceeds a reasonable rate of return on the tangible assets. So we're saying these tangible assets, here's the value, here's the rate of return, here's a total value based on that. The excess earnings are then capitalized at a specific rate, an appropriate rate. So we're going to show an actual example so you can see it walk through a little bit. But it's two separate calculations. And what's a reasonable return on assets? We talked about this the other day, right? Part of that is what does the investor want to receive? Average return on assets for comparable companies is a place to start. Average return on assets within a specific industry is another great place. And it corresponds to relative liquidity and risk of the underlying assets. And what risk is that investor willing to take? So, but for our purposes, we can't just randomly state what an investor wants. We have to do some research and understand. So this is what we can look to. We can look to average for comparable companies and average within the industry. And again, going back to Where do we get that data for the industry? We can be looking at things like risk management associates. We can be looking at public company data that's published. We can also be going to actual industry associations and seeing what data they have that they can give you. So here's an excess earnings approach. So return on assets calculation. We have our adjusted current assets, 875,000 times 8%, that's 70,000. We have our adjusted depreciable assets, 675 times the 8%. So we're saying the return on our assets, the percentage is 8%. That's 54. So our total tangible assets, the return is 124,000. And that return on assets, as noted in this footnote, it comes from average industry statistics. So that's where we got that number from. If we go back a few slides, see the 1550 here, adjusted current assets and depreciable. If we go back to our adjusted net asset method, that's our total assets right there. If you see that, 1,550,000. So just so you can see how the example flows through. So then excess earnings approach, we're going to look at our earnings now. We have net income for this company of 250,000, and then less our return on those operating assets. That's what we just calculated, the 124,000. So our net income is 250. The income that we anticipated getting based upon our tangible assets, we anticipated 124. So our excess earnings is 126. So does that make sense to everyone? You have net income. That was the net income on the client's books. We calculated in the excess earnings approach, adjusted current assets, depreciable assets at a specific rate of return. And we said, based on these assets, we expect that the return on these assets should be 124,000. But the company actually generated a return of 250,000. So the excess earnings is 126. Then we're going to divide that by our capitalization rate, which I believe you already did in the income approach. So you can understand how do you build up to that capitalization rate. There's a bunch of factors in it, the risk-free rate, the small stock, the industry risk premium, the company specific risk, all of that together. So for this purpose, we are given the capitalization rate, 24.5. So the value of the intangible assets now is 514,000. And then our adjusted net assets, which is again what we determined earlier, it's 1.185 million. So going back again, we have 514 intangible, 1.185 as our adjusted net assets. Our total equity value is 1.7 million. So to kind of recap what we did, we took our assets on our books, our company's assets, we got rid of any intangible assets, maybe not the best way to state it, right? We adjusted out any of our intangible assets. We adjusted all of our other tangible assets to their fair market values. And then we came up with what would be a return on those assets. So first that gave us our total asset value, our adjusted net assets of 1.185. And then from there we calculated what would be a good return on that. That would be 124. So then from there we said, what's our excess return? Our excess is the 126 because we had net income of 250, 250 minus 124. And then we multiplied that, divided by that by our capitalization rate to come up with our intangible value of 514, which we then added to our adjusted net assets. So this gives us our excess earnings approach and our value of 1.7 million. So now we're going to go and look at a market approach, the market approach, excuse me. Two main methods of looking at the market approach. We have the completed transaction method, CTM, and Guideline public comparable method, GPCM. And basically, we talked about this. I'm sure you talked about this probably in day one. There's the asset approach, the income approach, and the market approach. And then under these approaches, each of these approaches, there's different methods that can be used. So now we're going to look at two of the methods that fall under the market approach, then try to really understand how do we calculate a value based on the market. And to think about the market, and especially the completed transactions. And a good example of this, if any of you own or have owned a house in the past, when you go to buy a house and you're trying to determine the value of your house, where do you go to find that value aside from a real estate appraiser? But where does the real estate appraiser go? Where do you go to understand that value? You go to other houses that have sold in the market. You want to know what sold down the street from you, understanding that you want to look at houses that are comparable to your house. A mansion down the street is not going to be the same as a single floor ranch, which is not going to be the same as a trailer, which is not going to be the same as any other home, right? You have to look at homes that are comparable. Same thing here when we're looking at business valuation. When we're looking at a company, we have to make sure that what we're comparing to makes sense. So I'm not going to compare a pharmacy to a florist. So I can't just choose any company or any cash flows. I need to really make sure that what I'm looking at is comparable. I've found some valuators that all they do is a market approach, and kind of their thinking is, and by all they do, I mean they rely heavily on it, and their thinking is that nothing tells you better than what's out there in the market. Now, I don't hold that to be the case, because my feeling is oftentimes the market data is, one, incomplete or unreliable, and two, it's not apples to apples. Even a company in the same industry isn't necessarily going to be operating the same. It's not. So the market approach is great, and it's definitely a good approach to use, but I wouldn't say that that's all I rely on, and I wouldn't even look at the other approaches. That just, to me, doesn't really make sense. You want to make sure that you're looking at all the methods and really understanding what makes sense. And we'll talk a little bit more about that. That's choosing your method at the end. Choosing, of all these calculations we've done, what makes sense. So where do the transactions come from? They come from the market, where willing buyers and sellers meet. So who seek to negotiate the best deal. So theoretically, it's the best price you can get for your business because they're transactions that have already happened. We have another attendance check here. Everyone wants to make sure they do that quickly. And while you're doing that attendance check, why do we consider the market approach and valuation? We're going to go right back to the basics, right? Revenue ruling 5960 again. That is our guide. That's one of our major guides for valuation. So revenue ruling 5960 specifically tells us valuation of securities is in essence a prophecy as to the future. It must be based on facts available at the required date of appraisal. As a generalization, the prices of stocks which are traded in volume in a free and active market by informed persons thus reflects the consensus of the investing public as to what the future holds for corporations and industries represented. When a stock is closely held, so not out on the market, it's traded infrequently or is traded in an erratic market, some other measure of value must be used. In many instances, the next best measure may be found in the prices at which the stocks of companies engaged in the same or similar line of business are selling in a free and open market. So we're saying that we have an electronics store that sells specific electronics equipment or whatever it is, and they're not publicly traded. They're not out there on a securities and exchange, so, or the NASDAQ, or they're not out in the stock market. So how do we value that company? Well, maybe we go and look at what Apple's doing on the stock market. Again, you have to be careful, right? They're not apples to apples. There are definitely differences in the companies, but that stock that's being freely traded among willing market participants, it can give us a guide to what our company might be worth. So completed transaction method, that's one of the approaches we'll talk about. That's a total market analysis. And they include actual transactions of control positions. So portions of a company that have been sold that are control portions of the company. And then the Guideline public company method is a best fit analysis in looking at day-to-day trading of minority interests. So important to understand whether you're looking at a minority interest or a control position, especially when you're determining which data set you want to use and which approach makes the most sense. For the completed transaction method, we're going to be looking at a principle of substitution. So what does that mean? The economic value of anything tends to be determined by the cost of acquiring an equally desirable substitute. So much like the home example I gave you, if you have a 3-bedroom, 2-bath Cape on X street in X town, you might look to other 3-bedroom, 2-bath Capes in the same area of the same town if we want to understand the value of that substitution. With the stock market, as I said, you might want to look to other stocks that have sold. So they don't have to be identical, but they do have to be substantially equivalent. So understanding your company first, we already talked about understanding your company. Then after you understand your company, you can then go look at some of these completed transactions and understand whether they are substantially equivalent, much like the house. You know, the house might have a different color or a bigger garage or something different, but it's substantially equivalent and you can compare the two. That's what we're trying to accomplish here with a market approach. So how do we go about this? Look at actual sales transactions completed in the market. Most often sales of entire businesses for a completed transaction method. You're always in a control position, but typically it's just the entire company has sold, not necessarily just a control portion. And information is gathered from transaction databases. Underlying premise, the actual transaction that has taken place to establish price multiples can be applied to similar businesses. So company X sold for 1.2 times revenue. We can then say, perhaps our company is worth 1.2 times revenue. So similar to the comparable method of valuing real estate. I already talked about that. The completed transaction method, you know, there's going to be some limitations. How good is the data that's being published? When did these transactions take place? There's things like that that we need to consider. Same as if you're doing a real estate transaction deal. The house down the street 5 years ago is not necessarily comparable to the house down the street today for what it's selling for. So we have to understand the data that we're looking at and make sure that we're using the right data. Recap: equity versus invested capital, or our enterprise value. So you talked about this earlier in the week. Equity, what is equity? That's the value to the shareholder, the value that the shareholder has in the company. Whereas invested capital or enterprise value is the value of the company as a whole. So if a company has a specific amount of debt, then the invested capital less that debt is going to give us our equity value. That's back to our original accounting equation again. So what's our value definition? Price and equity is the value to the stockholders. Market value of invested capital or tangible invested capital is value to the stockholders and debtors, the value to both of them. What would the debtors get when they walk away? What do the stockholders get when they walk away? When we're looking at equity, we're looking at just what do the stockholders get when they walk away. So what are some of our applicable multiples when we're looking at a completed transaction? If we're looking at equity, we're looking at our price to revenue, a price to earnings, price to equity cash flow, and a price to book value. And it's important when we're looking at the completed transaction method and we're looking at the databases, are we looking at values that were on an equity basis or a market value of invested capital basis? And you can sort them to make sure you're using the proper ones. And where do we get these transaction databases? You know, go to NACVA, you can get BV databases, you can apply to subscriptions. So that is something that you do outside of, say, the valuation. If you're using a software or using Excel, you'll apply to actual databases to get this information. You also could get completed transaction information from sales from an actual, if you know of companies that have sold, those are less common and less easy. Getting a database and understanding the databases, and we'll talk about the databases. There's different databases. Some are better for certain valuations and not for other valuations. They each have kind of their place. So then the next part, the market value of invested capital, how does that tend to look in the sale transaction? So market value of invested capital to revenue, market value of invested capital to earnings before interest, taxes, depreciation, and amortization, EBITDA, market value to EBIT, the earnings before interest and taxes, and tangible book value of invested capital. So that's how, this is just telling us when we get the transaction database and we select our transactions, this is the data that we're going to compare to our company. So we're going to take, they'll say, let's say market value invested capital to revenue is 0.8, and we're going to apply that to our company. So just understanding this gives you kind of an overview of what is the database going to be telling you. Now we're going to look at examples on what do we do with those numbers that they're telling us. Most often used multiples. What is most often used for small companies? We tend to use discretionary earnings in the gross revenue multiple method. So gross revenue multiple method is super easy to explain. It's just looking at revenues times some sort of factor. You know, I think CPA firms, it used to be that most CPA firms sell for 1.2 times revenue. I haven't looked at a CPA firm in a long time, so I'm not sure if that multiple is still similar, but how we would look at that is, okay, if they tend to sell for 1.2 times revenue, what's the revenue? Multiply it by 1.2, and that's the value. So discretionary earnings, this is what's the actual earnings that are discretionary. What are the earnings that the owners have say over what happens to those earnings? It's not having to go pay debt. It's not having to go pay salaries and operations. It's earnings that are left over after all that. So what do we look at here? We look at our normalized income, and then we want to add back those discretionary items. So, you know, some common ones, meals and entertainment. And we talked about this in our normalization adjustments, right? But also shareholder salaries or rental expense above fair market value, things like that. So small companies, we tend to use those two factors when we're comparing to completed transactions. Larger companies, we are looking at the tangible investment, the market value of invested capital to EBITDA, earnings before interest, taxes, depreciation, and amortization. That's the most common for the larger companies. So, and you'll hear, we had a client say this not long ago. They wanted a valuation for M&A purposes, merger and acquisition purposes, and we're working on that. And you know, the valuation wasn't happening fast enough for them. And I joke, like it was happening in the time that it's supposed to, but they called us and said, but what's our EBITDA? What's our EBITDA? Can you tell us our EBITDA? And we're not their accountants, so we're truly thinking they want to know their EBITDA, you know, and we said, we'll calculate it and get it to you. So we do that, and they were like, yeah, but that doesn't make any sense. Like the people we talk to say that the EBITDA should be 7 to 8 times or something like that. And it's like, oh, they've been talking to people in whatever people they're talking to, they're looking at market multiples, a multiple of EBITDA. So what is being seen in the industry for their industry times EBITDA, but they equated that and understood that to be EBITDA. So it's interesting with different levels of sophistication of clients. They don't always even understand what you're talking about. So, and speaking of that, you want to make sure that you're really clear in any report that you write to explain what you're talking about so that the lay reader, the lay person can understand the valuation and how you came to the value that you came to. So what are some of the databases that we can use to get this data? So we have a BizComps database. That tends to be private companies, less than $1 million. IBA database, private companies at less than $1 million as well. Pratt stats are companies value of 1 to 100 million, so larger companies. BizComps, we're looking more, at our mom and pop shops, our Main Street businesses. Pratt stats, we're looking at our larger companies. And then Done Deals has private and public data for 1 to 100 million. So again, larger company deals, but we also have public and private data within that. So these are some of the databases. It's very handy, but to be cautious, especially if you're using like a software, you don't want to just go in and grab Done Deals without even thinking. If you have a company that's, a Main Street florist that has sales of 700,000, did you really want Done Deals? Maybe you wanted a BizComps or an IBA instead. So really thinking about that. So the BizComps database contains transactional information on Main Street businesses, restaurants, beauty salons, florists. But they focus on business transactions that are smaller, and the emphasis tends to be on food service and restaurants, service businesses, personal services, so accounting, legal, that sort of thing, investment advisors. The data is segmented by geographical location, so you can look for, the Northeast or whatever specific location you're looking at. And that database has over 6,000 transactions now. And it grows, every year. As more transactions happen and more transactions are reported, there's more information in the database. The information being received, it receives financial information from business brokers and transaction intermediaries. So that's the person in the middle of the transaction. They are, the brokers or the transaction intermediaries are then reporting back to the BizComps database. And it's funny, oftentimes, how are they enticed into doing it? Why do they want to do it? Well, because the brokers and the intermediaries want good data. So they want to supply it so they can then get good data. And oftentimes you can get that data for free if you supply X amount of transactions. So like a broker, if they provide BizComps, I'm making up this number, but 5 completed transactional data for the year, then they might get the database of transactions for free the following year or whatever it is. So there's benefits to the brokers and the intermediaries to give good data. Now, that being said, it's incumbent on those people to actually provide good data. If you're looking at sales of stocks on the open stock market, that data is actually the real data. When you're looking at this data, you're looking at what the broker or the intermediary was willing to provide. So sometimes the data is going to be incomplete. Maybe it's not 100% accurate. So just to understand those limitations. 85% of merger and acquisition deals have annual gross revenues under $1 million in the BizComps database. So again, that's where we want to know, we're looking at Main Street businesses. We're looking at the smaller companies. All sales in here are asset transactions. They exclude cash, accounts receivable, real estate, AP, inventory. So why is that important? So if our company, if we're analyzing our company and we want to compare it to the BizComps database, but let's say we're doing it for merger and acquisition purposes, if our company is going to be, let's take the accounting firm. I said a CPA firm tends to sell or used to sell for 1.2 times revenues, right? If we put that, but then in the sale that we're looking at, included in that is going to be cash, accounts receivable, real estate, AP, and inventory. Well, then we can't just take 1.2 because in the BizComps database, all of that was excluded from the data. So it was 1.2 times revenue plus any cash, plus any AR, plus any real estate, plus any AP and inventory, or those were just excluded from the sale altogether. So understanding that what data is being reported and making sure that your comparables actually compare to the data. Furniture, fixtures, and equipment is included in the sales price in the BizComps database. We have another attendance check up there. Two voted out of three. All right, so the IBA database, so that's the largest database of databases. There's over 23,000 transactions starting back from 1970. They are sales of 100% controlling interest, so the entire business sold. It represents asset transactions only. It does not mean that all assets and liabilities were included. And again, that's one of those limitations, right? If we're going to rely heavily on the market method and we're going to use some of these transactions, then we're going to want to dig down into the actual transaction and understand what was included in that transaction and what was not. Compiled by business appraisers, accountants, intermediaries, and business brokers. Again, people that are giving the data in, cautious of the data in is only, the data out, I should say, is only as good as the data in. So just understanding that and being cautious of that. Typical sales in the IBA database, what's included? So this chart gives us a nice example of what tends to be included. Cash is not included. Receivables are not included. Inventory typically is included. Fixed assets tends to be included, but real estate does not. That's usually separate. Goodwill is included. And covenants are included if they've been reported to IBA. Other assets typically no. Leases sometimes, and contracts, yes. So what about liabilities? So where's the liabilities? Generally, liabilities associated with assets sold are included. So notes payable secured by fixed assets. Or if we had a vehicle and a vehicle loan offsetting it, those would be included together, the net of the two. Accounts payable are typically not included, and other liabilities are generally not included either. More than PratStats database. Now remember, this was a larger database. PratStats currently more than 5,000 transactions, increases approximately by 300 transactions per year. And this was a little while ago, so we're probably up over 6,000 at this point. Offers more detailed data than the others. So the other databases aren't going to give you quite the detail that you're going to get from being able to look at and research the PratStats database. This is the purchase and sale of 100% controlling interest again. The transactions are provided by business brokers. This is an important one in my opinion, but over 90% of data has been entered since 1995, as opposed to 1970 that we saw in the IBA database. So the PratStats database is going to be theoretically more current. Now, you know, I can't say that for sure, and it depends on the transactions. And luckily, when you search these databases, you can sort by date too and see whether you think things are relevant or not relevant and why. Because it doesn't mean that the older data is not relevant. It may be, but you have to analyze the transactions. And then 65% of the transactions in this database are between 1 and 30 million. So understanding they're larger, significantly larger than BizComps and the other databases that we looked at. Done deals database. So this one's another larger database, over 8,000 completed transactions. So lots and lots of data included here. And it comes from company financial reports filed with the SEC. So what does that mean to us? That means this is good data, right? This data has been audited by a company and submitted to the SEC. So instead of relying on accountants and brokers and transaction intermediaries, we are relying on actual audited financial information that's been given to the SEC, the Securities and Exchange Commission. So I would say the quality of the data that's in here is significantly better than any database that you could ask for. Done Deals reviews 250,000 pages of filing data annually. Private and public middle market transactions, revenues generally over 10 million. And they contain both stock and asset transactions. So again, looking at, we have to separate out whether it's a stock transaction or an asset transaction to be able to compare to our company and making sure that we're understanding the numbers and where they're coming from. All right, so how do we use the completed transaction method? What do? We talked about the databases. You know, we've understood now where we can get some of these databases, but now what do we do? So first, we're going to perform a search and select our appropriate transactions and review them for comparability to our subject company. And I can say one thing that you absolutely want to do and have handy is, you know, have your notebook handy, your computer, if you're not old like me. No, we'll have our computer handy, but you want to start making notes now. And why is this important? Because this will make it so much easier when you go to write a report. So if you're doing a completed transaction method, you first want to perform your search. And so you're going to go into a database like Done Deals or BizComps and say, okay, here's what I'm looking for. I would start, typically how I like to start, and it's preference on the evaluator. There's different ways that you could do this. But I like to start with what industry do I operate in? And I'll use the NAICS code, typically the North American Industry Classification Code, NAICS. And I'll start there. And I'll start with, if they allow that, if not, I'll use the SIC code, the Standard Industry Code. I'll start with those and do a search. So, and I'll start big. So I'll start with my entire code, you know, and say the code is, let's use a SIC code because it's shorter, so I can give you an example easier. So if we're in the industry and our industry code is 8601, and I don't know what industry that is, I'm just making it up, but our industry is 8601. I'm going to pull up the database and I'm going to first make a note, make a note in my notes that there are 7,000 transactions currently in this database. So this is what I'm searching. I'm looking at this specific database. I want to make sure I'm explaining why I thought this database was relevant. And then I'm going to say what's included in this database. And then next I'm going to add in the SIC code that I said, and I don't even remember what I said now. So we're going to say 8701. So I'm going to type in 8701. And then the system's going to come back and say, on a lucky day, the system's going to come back and say, there are 50 transactions in our database under that same industry code. And I'm going to be very happy. Now, what often will happen though, is that we'll put in the 8701, let's say, and nothing will come back. It's like, oh, there's nothing for my industry, not under that SIC code. So then you can change it and do 870. So, okay, now I'm searching a little bit less specific, but still within my industry. And that might come back and say 2 transactions or no transactions. Now, if it's a small amount or not enough, then I might want to go back and say, let's search for 87, drop off the last 2 digits. So we're getting a little broader. It's like when we talked about the industry, and when we talked about the economy, looking at the global economy way down to the town in which we operate. That's what we're doing here. We're starting big and we're narrowing it down. Or we're starting small, actually, and narrowing it up if we don't find data that's relevant. So then at the end of the day, we say, okay, did we get enough transactions in this industry in order to be comparable to our company and to make an analysis? Now, if we don't, what are some of the other things we could look at? We can look at geographical location, or what if we do get 50 or 100 or 2,000 transactions? And that's too much data. Perhaps we want to look at geography. Perhaps we want to narrow the search to the past 10 years. We don't want to use the whole database in every year, going back to, say, 1970, depending on which database you're using. But all along, as I'm editing these items, I'm making notes on what I did, because I want my reader to be able to duplicate my efforts. My reader should be able to see what I've done and come up with the same result that I came up with. Whether they agree with me or not, they should be able to replicate it. So that's why I'm talking about, you know, having pen and paper or you know, your separate monitor on your screen, writing down what you're doing so you remember what you've done. It also helps you so that you're not spinning wheels, because maybe 8701 gave me 10 transactions and I thought that was okay, but I wanted to try some other methods. And I tried some other things and then I couldn't remember what had given me 10. You know, have your notes handy. The other thing to be cautious of is that, especially if we're looking at the industry data, there can be different industries or similar industries. Like, are we talking manufacturing, the general manufacturing industry, or are we talking about electrical manufacturing within the general manufacturing industry? So what are we looking at? There might be more than one SIC code or NICS code that makes sense for our company, and we're going to want to research that. So then once we've done that, also how can we narrow it? So we talked about narrowing it down based on dates of transactions. We talked about narrowing it down based on industry. We could look also at size, revenue, assets, locations. We can look at growth, the revenue and the earnings. We can look at liquidity. How much does a company have in liquid assets, their profitability, and then their leverage and their debt. What's out there for leverage? So these are some of the ways that we can take that transaction database and make sure that it's making sense for our company. And if you find a database that you feel has good data, it doesn't mean you can't search another database. You can, it's one of these, you could run down a rabbit hole. You don't want to search every single database you could find, and you don't want to look at every single transaction. You have to become efficient in understanding. But this gives us an idea of how do we search a database, what are we looking for in the database, and then after we've done this, how do we compare it to our company? So select appropriate multiples for guideline transactions, emphasize ratios with smallest coefficient of variance. And what that means is a larger coefficient of variation, the data might not be as reliable. Apply appropriate multiples to the subject company's financial variables, and adjust the value for any non-operating assets, discounts, or premiums. So understanding how this works. Going back to the accounting firm, a CPA firm, that the 1.2 that I said. So I found that the multiple of revenues is 1.2. That's selecting the appropriate multiples. I said, this makes sense, and this is what the guideline transactions are telling me. Then I'm going to apply that to my company. I'm going to say my company's revenues are $1 million, so the business valuation is 1.2 million, right? The value of the company based on that. And then I'm going to adjust that value for any non-operating assets in discounts or premiums. So I took the revenue of $1 million, I multiplied it by 1.2 because that's what I found in these market multiples. I got 1.2 million of revenue, of value, and then I'm adjusting it. Let's say I had non-operating assets. I had land that is not pivotal to operations, and that's 200,000. So I'm going to add that in. And then let's say I had investments of another 200,000 that were not pivotal, did not affect operations. So now I'm at a value, I don't know if you're following this, I'm writing it down as I talk, $1.24 million is our value. So, okay, I took the value based on the multiple, I added in non-operating assets. Now I need to look at discounts or premiums. So is there a discount for lack of marketability? Is there a discount for lack of control? And if so, I need to take these discounts out of my 1.24 million to come to my actual value. So what are some problems and weaknesses with the completed transaction method? Sufficient number of transactions might not be available, and I find that often, depending on what industry I'm looking at. There's quite often that I can't use a market approach because there is not sufficient data out there regarding the industry that my company is operating in. Available transactions may be significantly different in size. There might be limitations on availability and quality of data within the databases. Sometimes the data is missing or incomplete. As I noted, if we're using one of those databases that come from a broker or an accountant or an intermediary, that data, they don't have a vested interest in providing all the data or providing it all timely. So you just have to be careful. And then limited financial information on the target company. So you just have to understand that data has its limitations. And that's why, you know, it's a good method to use, but sometimes can be used more as a sanity check than a full valuation method. Other times it is the full valuation method. It's what we rely on. So understanding, again, this comes to the part of this is why somebody is hiring a professional and paying, you know, $10,000-ish for a valuation, or thousands of dollars, whatever it is. They're relying on you to make all these decisions. If it was as simple as saying it should be 1.2 times revenue, anybody could do this. So we are the ones who have to really make these judgment calls and make sure that we're applying sound judgment and sound theory to our valuations. So advantages of the completed transaction method: prices are derived from actual data on transactions completed in the marketplace. So, you know, people actually purchased and sold businesses for these amounts. So we know that there was a ready market and that's what someone paid. Market multiples are familiar and easy to understand. So unlike the capitalization of earnings, where we had to do a whole build-up and come up with our number and try to explain that to a judge or a trier of fact, and they might not understand what you're saying. Market multiples are easy. If I say it's 8 times EBITDA and I explain to the client what EBITDA is, they understand that. If I say it's 2 times revenue, they can understand that easily. And it doesn't require forecasting of future earnings. It is based on the current numbers, the current earnings. So those are some of the advantages of a completed transaction method. Other advantages, and please note that you have another attendance check here, but other advantages: prices are for controlling interests, so no control adjustment is necessary. Data reflects private company transactions. Data includes many industries not represented in the public markets. So, you know, there'll be things like those mom and pop businesses. They're not selling on the stock market. You're not going and buying, you know, hairstylists businesses on the stock market. You're buying larger companies, manufacturers, things like that. So the completed transaction method will give you a lot of these other companies and their data. Other possible uses of the databases: develop sense of industry prior to meeting with the clients. That's great. You know, get to know the industry. We talked about getting to analyze the financials and understand the financials before talking to the company, but also understand the industry. Understand the industry from the sense of what has sold in the industry. Alleviate unrealistic expectations of buyers and sellers. You know, a seller might think the company's worth $5 million, a buyer might think it's worth $2 million. Well, if it's typically based on market information, this size company is sold for $4 million across the board in the past, well, then neither one of those, buyer or seller, was accurate in their assessment. So, but you can give them this data and say, look, why would you think that you're worth so much more than this other place that sold for X amount? And then assist in negotiations when formal business valuation is not practical. You know, we have to do formal valuations for gift and estate tax purposes. We need to, if we're doing litigation, we're going to court. You'll often need to for loan financing, especially if there's specific guarantees. But there's plenty of times where you can be consulting with clients and helping them understand an estimate of value when you're not performing a formal business valuation. And looking at these completed transaction databases can help us in doing that. So here's an example of, excuse me, doing a search. Here's our comparable transactions. We were looking at hardware stores, which had SIC code of 5251, 5531, 5211, and I think that might be it. So see where I said sometimes there's more than one industry code and they can be similar. That's you can see that right here. So we went into this database, we searched up these SIC codes and felt that these companies were similar enough to our company and our operations to make sense. And you can see the time frame was 2002 to 2007. It's a relatively tight time frame. You can see the net sales for each of these companies. You can see the market value of invested capital, and then what's the market value of invested capital to sales. So we've done our search, we've looked through the database, we've selected transactions, and then we're exporting these transactions to say, here's our database. So whatever number of transactions there are here, it looks like maybe, I don't know, 13 or more. We averaged that together and said, what's our average multiple of revenue of sales? It's 0.42. So I was talking about an accounting firm in 1.2. That's what this is giving you. It's an average multiple of revenue compared to the market value of invested capital. So 0.42 here. And this comes right from downloading these transactions from a database. Or if you didn't have a database, you can search up these transactions and create the spreadsheet on your own. So then how do we apply the completed transaction method? We say, okay, our estimated annual sales is 2.5 million. Our market multiple is 0.42, and that's directly the average of what we got from our transactions that we thought made sense. Our preliminary value is 1.05 million. Now we need to do our adjustments. Remember, some items aren't included, some might be non-operating. Here we're adding back our accounts receivable and our real estate. And our actual enterprise value in that case is 2.05 million. And then on this one, we're saying there's a marketability discount of 15%, so we have to take 307 off. Our indicated fair market value is 1.7 million. So hopefully that makes sense to everybody. How did we get our database? How did we select our transactions? And then we downloaded our transactions and took an average of something that made sense. Here's MVIC, market value of invested capital to sales. And then we applied this to our company, the 0.42 times our annual sales. And then we added back non-operating assets and we took a marketability discount. So that's the completed transaction method. So now Guideline public company method. This focuses on market prices of comparable publicly traded companies. So now, again, the data here is going to be some pretty good data, right? It's publicly traded. We know that that data is accurate. That's out there. Multiples are derived from sources and applied to the subject interest. And we can use it to derive at market value of invested capital or the market value of equity. So what are some considerations? Search multiple sources, right? Don't just rely on one database. Obtain an adequate number of comparables. If you do a search and all you find is one comparable company, I don't know that that cuts it as being adequate. I might use it as a sanity check and does it make sense, but there's not enough data set there to have something to be able to say that it's comparable. You want to maintain consistent time periods. And then you want to make sure you're normalizing when it's appropriate. So using the Guideline public companies method, you want to calculate the current trading market multiples, So market value of equity is the share price of X and the number of outstanding shares. Identify and calculate appropriate financial parameters. So what does that mean? Our pre-tax income, our net income, our cash flow, and our book value of equity. Multiple is the market value of equity divided by whatever financial parameter that was. So MVE divided by cash flow, etc. You want to calculate the current trading multiples, market value of vested capital, market value of an equity plus net debt times long-term debt minus cash. And these, this is getting into a little bit deeper theory, but understanding that this formula is going to be the same across the board. So as long as you're understanding what market value of invested capital is, right? Remember, that's the value to the debt holders and the equity holders, not just the equity holders. And that's going to be equal to the market value of the equity plus the net debt, the equity plus the debt. Identify and calculate appropriate financial parameters. So revenue, that one's obvious. Earnings before interest, taxes, depreciation, amortization, the earnings before interest and taxes, or a debt-free cash flow. And then our multiple is going to be the MVIC, market value of invested capital, over whichever financial parameter we're choosing. So revenue, EBITDA, etc. Multiples should be computed based on the last 12 months data, LTM. So it's the trailing 12 months. So not the last full fiscal year, if that makes sense. So you're not necessarily using 12/31/19. You might be using the 12 months ended June 30th, 2020, even though we haven't hit June 30th. Multiples should be based on last 12 months, obtain historical financial information. So the latest 10K and 10Qs. Use the balance sheet as of the last 12-month period, and normalize the financial data if that's appropriate. Compute the last 12 months data as of March 31st, 2008. So here's an example. This is just how does the last 12 months work? It's a rolling 12 months. So you're not using the last fiscal year necessarily. You want a rolling of the last 12 months. So this is just showing you how would you do that. You have quarter 2, 3, and 4. You have to add on quarter 1 to get the last 12 months. Hopefully that makes sense to everybody. Comparable, then you want to compile the comparable data. So now this is coming directly from the 10Ks and the 10Qs, right? And you can do some research online, compile the comparable data. Here you have company, we have their ticker symbol on the stock exchange. So Nortech Systems, NSYS. Valuation measures, we have market cap and enterprise value. Financial highlights, when was their year end, what's their most recent quarter. We have our revenue and our EBITDA from our income statement, and it's LTM, the last 12 months, right? And then we have our valuation multiples, the last 12 months of revenue, the enterprise value over the last 12 months of revenue. So then, much like the other database we used, we're going to gather this data, get this information, put it all into a chart, and then we can take the average of these. Now, what's the difference between the average way over to the right and the adjusted average? I don't know if anyone can see it right off just by looking at it. The major difference is that we got rid of any multipliers that didn't make sense, any outliers that were out there. So how do we determine that? Well, we look at the data and say, what is not seeming to make sense for our data? So let's look a little further here. Oh, is it going to give us this one? Okay, so it's not telling us, but I think what it says here, I believe what has been omitted is the transaction for Sertran, enterprise value over a long last 12 months of revenue. That 1.65 is significantly higher than any of the other companies. Do you see that? 0.31, 0.5, 24, 74, and then we have 1.65, and then 0.56 and 0.74. So we're throwing out the one that really doesn't make sense and coming up with a new adjusted average. So take out any outliers, and in the outliers, again, this is a Evaluator decision. You have to be able to look at the data and make decisions and decide how we're going to do something. So how do we apply the multiples? We want to select our appropriate multiple. We want to examine any dispersion, look at our standard deviations. We want to consider our mean, median, and adjust any outliers. And remember, the mean is the average, the median, think of it like a road, the median is right in the middle. So what tends to be more important or more meaningful is really up to the evaluator, but whether you want an average or whether you want the number that fell right in the middle. Then you want to adjust the multiple up and down based on relative strengths and weaknesses of the company. So we said, go back to the 1.2 for a CPA firm. Okay, so I'm saying that makes sense, right? But maybe our CPA firm that I'm looking at today is not run that well. Maybe I know that the depth of management is not very good, or maybe I know that the client base is not very stable or something like that. So I might want to adjust that multiple up or down based on those factors. We want to apply the multiple to appropriate data, our normalized data. And here's how we're doing this. So last 12 months of EBITDA is 1.5 million. We got our market multiple of 8.86. So if we go up a couple slides, 8.86, write down our adjusted enterprise value based on the last 12 months of EBITDA, right? So 1.5 times the 8.86, and we have our implied enterprise value of 13.29 million. We want to take out our last 12 months of debt, and then our implied equity value we arrive at is 10.5 million. Then from there, we want to apply our discounts. So here we have a lack of marketability because our company, unlike the companies that we have in this chart, our company is not sold on the stock market. It doesn't have that ready market for sale. So there's a discount for that. And then we come up with our indicated fair market value of 9 million. So clearly, well, I think clearly, I don't know if everyone else would agree clearly, but I think clearly easier than an income approach in terms of the multiple that you're using. However, you have to do the research in the databases and you might not always find good information. So there's those items to consider, and also is the information good that you're receiving. So, but this is how we do the Guideline Public Company method. Problems and weaknesses with this method. Comparability to small, closely held businesses can be difficult because publicly traded companies are large. They tend to be much, much larger than any of the companies we're looking at. Events affecting a specific company will immediately impact market prices of that stock, which would distort multiples. So speaking of, you know, we have COVID and the pandemic going on. The market dipped significantly back in February, right? Like a huge, the largest dip it's had in years. Okay, well, that might be a little bit of skewed data because will it recover, will it not? But if we're using that price at that specific date, that could be a problem, that could be a weakness. Advantages of a Guideline Public Company method: market-based valuation multiples are dynamic. Market multiples reflect current market values at a specific point in time. They change as the industry and economic changes. So, you know, when we looked at completed transactions, we said, okay, here's these completed transactions, but some of them happened years ago. Whereas Guideline Public Company, we can look at up-to-date current data. And the multiples are continuing to change over time. We have another attendance check there for everyone to please check in. The other limitation, the other advantage of Guideline Public Company method is that there's a lot of information available. You can go out, get the 10Ks, get the 10Qs, and get this information. Everyone has access to it. It's public filings. So unlike a database where you have to spend money to get the information from the database, or if you're looking at private transactions that have happened, other Main Street businesses, etc., you don't have the ready access to that information. So that would be a disadvantage of the other method, an advantage of the Guideline public company method. And I want to remind again that there's an attendance check that's sitting out here for everyone. I'm going to give you just a minute, see if we hit that attendance mark, excuse me. So selecting appropriate method, what do we want to consider? Company characteristics, the nature of the business. Is it an operating business versus a non-operating business? Is it a holding company for real estate? How profitable are they? What's the history of the company? Or are they a startup entity, which can make them more risky and potentially not have as good of data? We want to analyze the interest being valued. So are we looking at a controlling interest or a minority interest? And that's very important. And we explained why with some of these different methods. We want to look at the standard and premise of value. So fair market value versus an investment or synergistic value, going concern versus liquidation. So what are the differences of some of these? So fair market value, willing buyer, willing seller, there's a ready market out there. Everyone in it has relevant knowledge of facts, but investment or strategic value, you have a specific buyer in mind, or two specific people are coming together. There's a specific investor in mind, and we might be looking at a synergistic value. So if you have a manufacturing operation, large manufacturing operation, let's say, and they are looking at another manufacturing company and they might want to purchase them or absorb them, could be for a few reasons. Perhaps they want to gain the employees. The job market can be difficult to fill. So maybe you want to buy another company just to get their employees. Maybe you want to buy another company to expand your geographical base. Maybe you want to expand your client base. But whatever that reasoning is, there might be some investment or synergistic value there. For instance, you might be able to buy that company and have no overhead because you can absorb it all into your current operations. Well, in that case, you might be willing to pay more money for that because you're going to end up with more money at the end of the day. Then you're looking at a strategic value, a synergistic value. Now, what's the difference between a going concern and a liquidation value? A going concern assumes that the business is going to continue in the same form that it's continuing now. Whereas a liquidation value, we're liquidating the assets. They're selling them at auction. Think of it like a house again. If you're selling your house on the open market, you're going to get, especially nowadays, a fair market value price for that house. Things are selling quickly typically, at least in the area I'm in. Whereas liquidation value, that's when your house has to go to auction, let's say. Well, it's going to be worth significantly less at auction. People are going to pay less. So same thing with a company. A liquidation value and auction type value is going to be lower than a going concern value typically. Combining or averaging methods. This is a great little slide, and I'll just read you what Revenue Ruling 5960 says about this. Because valuations are not made on the basis of a prescribed formula, it's difficult for the various applicable factors in a particular case to be assigned mathematical weights in deriving the fair market value. For this reason, no useful purpose is served by taking advantage of several factors, book value, capitalized earnings, etc., and basing the value on the result. Such a process excludes active consideration of other pertinent factors, and the end result cannot be supported by a realistic application of the significant facts in the case, except by mere chance. So you might look at this and say, IRS does not allow you to average the methods, and that's not the case, though it sounds like that. what this is saying is you have to think about it. And what are we even talking about with combining and averaging methods, right? What am I even getting at here? What I'm getting at is we did, let's say, an asset approach, and the value of the assets were $1 million, right? And then we did a market approach, and the value based on a market approach was 4 million. I'm going to see if I can do this and actually give you real numbers off my head. I'm not sure I'll be able to do that, but I'm going to write it down. So asset was 1 million. Income, I don't know which one I said. Income was 4 million. And then a market approach was 2 million. I'm not going to be able to do that in my head, am I? So asset, income, and a market approach, they all came up with different numbers, and I say, okay, I think to come up with our final conclusion of value, what I'm going to do is I'm going to average those together. I'm going to take 4, 5, 6, 7 million divided by 3. Shoot, I did not do that well. But 7 million divided by 3, and that's the average, whatever that comes out to. I'm not going to do it in my head. That's the average of those 3. My value is, we'll change it. 1,000,000, 4, and 4. So our value is 9 million. We divide it by 3. It's $3 million. So our value is $3 million that we're coming up with. We averaged the asset approach, the income, and the market approach, and came up with $3 million. Okay, well, why did we come up with $3 million? Why did we average those 3 methods? And if you really think about it, we came up with a value of 3 million doing that. Well, the assets were only worth 1 million. The income and the market approach were both worth 4 million. Why are we just randomly saying 3 million? You know, and especially if you think the asset approach often doesn't apply to an operating company, right? So by averaging these 3 methods together, we deflated the value of our company by $1 million, $1 million for really no reason. We don't have a good reason. We just did a lot of numbers and a lot of calculations and felt that we should include them all in our final value and averaged them. So that's what IRS is trying to make sure, and Revenue Ruling 5960 is trying to make sure that we're not doing. We're not just haphazardly running a bunch of numbers and calculating and then averaging it at the end. However, that's not to say we can't average them. So if our income approach had been 4 million and our market approach had been 5 million, and both of those were really made sense for this company. You know, we put a lot of work into the income approach and that really made sense. But we also got a lot of market data, and the market data was comparable, and everything made sense there. Well, then we might want to take the 4 million and the 5 million and average those. Maybe our value is 4.5 million. Maybe it's in between the income and the market approach on this one. So you can average, but you have to be able to back it up. And isn't that the case with most valuation? As long as you're not completely doing some method that makes no sense, you know, you have to apply sound theory. But once you do, then it's your decision, and you just have to back up your decision. Why do you feel this way? I talked about writing a report, you know, and talked about someone else has to be able to come to the same conclusion. It doesn't mean they're going to agree with your conclusion. Doesn't mean that if they were to do it, they would have the same conclusion. Maybe on this last example, maybe they say, I don't think you should have averaged the income and the market approach. I think it should have just been the income approach, and it's 4 million. I don't agree with the 4.5. That could be the case. Or you could go to court, let's say, and one valuator comes up with the 4 million. They thought the income approach made the most sense. The other valuator said 5 million. They thought theirs made the most sense. And who's going to win in court? It's one of 2 things. It's either going to be the trier of fact is going to average the 2 because they don't have any idea, or it's going to be whoever was most convincing when they gave their report, when they discussed how they came to their value, when they put together their report. The one that made the most sense is either going to be the winner, or they're just going to average the 2 because the trier of fact doesn't know. So understanding that and understanding what we're saying here about the combining and the averaging of methods. Then we come up with our final conclusion of value. And this, again, not an exact science. It's up to the valuation analyst, to use sound and professional judgment. So as long as what you're doing makes sense and is sound and professional, then you just need to be able to back up what you've put and what you've decided, the conclusions you've come to. So now we have some time if there's any questions, and it's 3:40. We have about 20 minutes if you have any questions. And again, I don't mind taking questions on stuff we talked about today or anything you might have covered the last 4 days. And you know, and if it's something I can't answer, like I said 2 days ago, I'm happy to get some answers for you and get back to you. There is another attendance check up there if you can make sure that you're doing that. But yeah, NACVA has a wealth of really great professionals to call upon. So there's plenty of people out there to help answer any questions, but I'm happy to take some now.
This is our last day with Karen, so I would take advantage of it, everything you can.
No open questions. Come on. Give me a question. Be interesting to hear from the group, and I know you don't have to unmute yourself and have to say this, but interesting to hear, you know, now that you've gone through each of the methods, is there a method that just based on the limited knowledge you've gotten is one method seem easier to you, harder to you? Are you scared to apply a specific method more than any other method? You know, that would be interesting to hear. Looks like we do have a question here. So can you go over, two good comments here. So first the question, can you go over again the differences among the completed transaction databases? Yes, and we can go back to that slide too and kind of look at them. And the other note, and I think this is a great note, I don't know what I don't know. I find the databases so suspect. It feels that the asset-based approach is easiest. And I would have to agree with you. I think the asset approach probably is the easiest in general, because you can get, that's especially if you're an accountant. I don't know if you are, but that's the numbers. You know, the numbers are what the numbers are. We can get a real estate appraisal. We can get an equipment appraisal. We can look at a cash bank statement and know that's what cash is. So that does tend to be the easiest. And you're right, though, that you don't know what you don't know, even especially as all of you would be new to valuation. I would assume that you don't know what you don't know, and you learn more and more as you go forward. Let's go back to the differences in the databases so that you can see that again. And I think these slides will be available to you as well. But different databases are good for different purposes. One database we didn't really talk about, and it's not accepted valuation, but it's a good database if you especially are looking either to do a sanity check or if you're looking for just doing some quick consultations with clients. That's the rules of thumb that are put out by the Business Reference Guide. So what happens in the rules of thumb is that you search by industry, and it's online now. It used to be a book that we would get every year. But the rules of thumb, you search by industry and you can get some of these statistics just in general for the industry. So without searching specific completed transactions, we can say, okay, in the florist industry or the CPA industry, because I talked about that one so much, you know, they tend to sell for 1.2 times revenue or whatever it is. That's a good kind of starting point or sanity check. But here's the databases again. So BizComps, private company transactions under $1 million, IBA database, private company transactions under $1 million, Pratt Stats, private company 1 to 100 million, so larger transactional database, larger deals. And then done deals, you can get public and private transactions, and it's 1 to 100 million. So those are the larger ones as well. So basically, looking at the databases, BizComps and IBA tend to be for your smaller mom and pop Main Street type businesses. Pratt Stats and Dun Deals tends to be for the larger ones. And then if we're looking at completed transactions, excuse me, not transactions. If we're looking for Guideline public company data, we want to look and do a search for the 10Qs and the 10Ks that have been filed with the Securities and Exchange Commission. So we want to look right to that public company data that's published out there. That's useful. And then the one that I mentioned that is not at all a substitute for doing evaluation, but you can look at the business reference guides, rules of thumb. Also gives you a nice little description of the industry and gives you some talking points with clients if you need it. So Risk Management Associates is another good place to look for industry data. It's not going to give you, these multiples, but it gives you some good data on ratios and information about the industry. Let's see. Okay, trying to see if we have anything else. I'm opening up the chat bar. I don't see anything else. Feel free to throw out any other questions you might have.
We have fulfilled our obligation for CPE time. So,
Okay.
So we're okay to leave, but I just want to make sure everyone gets their last chance to talk to Karen and get any questions answered.
Absolutely. You're welcome, Sherry. Thank you. You're welcome, John. Thank you.
Okay, if we don't have any other questions, then I guess we are good to go. We have one more day left. We will see you all tomorrow, and have a great afternoon or evening or morning, wherever you are. I have no idea.
That's right.
Could be anywhere. It's afternoon for me, but anyway, have a great day, and we will see you all tomorrow. Thanks.
Great. Thank you.
Thanks, Karen.
You're welcome.